So after overcoming the technical issues, let's start. I hope you can also see me. I'll use this for the introduction. We're going to talk about the big ECB meeting on Thursday and see the implications for euro-dollar. My name is Yohay Elam. I'm the founder of ForexCrunch. Very quick introduction about myself. I used to be a retail trader and a computer programmer. I founded ForexCrunch back in late 2008. The site focuses on fundamental analysis, but also touches on technical analysis. You're welcome to visit. Okay, let's see what we'll cover. The current situation in euro-dollar, some background for the ECB decision, all of Mario Draghi, head of the ECB, all these options and scenarios, and we'll have enough time for questions and answers. So, euro-dollar, this is a chart I captured earlier today. Current situation in euro-dollar, these are the lines that I see. We had the euro pushing up until early May, and then when Draghi began talking about action in June, we had a big downfall. We had a breakdown of the uptrend that accompanied the pair since around November last year. So we had a big collapse from almost 140, and now there's sort of a dead cat bounce. The pair is hugging 136, and that's the current situation. Talk about what was the mentality of euro-dollar. Until May 8th, no news was good news. So each time nothing happened in the markets, the euro found buyers and the euro went up. Seemed like the only way was up. It was a sort of buy the dips attitude. Each time euro fell because of some reason, it climbed its way up once again. We've seen flows from China and other places to buy bonds of Spain and Italy and other countries. All this money reaching for high yields certainly helped the euro. But everything changed in last month's ECB decision. It turned into sell the rallies attitude. Each time we had a rise in the euro, we saw it fall. Afterwards, each bounce was sort of a dead cat bounce. You know, even a dead cat bounces when you throw it on the floor. Sorry for some of you won't like that description, but that's a common market name. And the peripheral bonds, which I mentioned beforehand, they weren't a one-way street. So yields were falling. I mean, Chinese and others were buying bonds, but this sort of reached a standstill. Spanish, Italian bonds are not that cheap anymore. Okay, now let's talk about some background for the ECB decision. ECB, the European Central Bank, has only one target. It's not like in the US. The only one target it has is an inflation rate, headline inflation rate of 2% or a bit below. That's the definition, a bit below. Okay, it's not core inflation, it's not employment, it's only headline CPI, Consumer Price Index. This target is being missed month after month, and the low inflation means that the debt burden is heavier. It's harder to return debt, and also there is a danger of deflation. What is deflation? When prices fall, now you may say, I want to buy something for a cheaper price, and when you wait for the price to fall once again, and you don't buy, then factories will produce less goods, and then people might lose jobs, and then there's less disposable income to buy goods with. That's what happened in the Great Depression, back in the 30s, and that's what happened in Japan in the last 2 decades, and then in the past year and a half, Japan has been fighting it, and we can see the result: a crash of the yen, and the economy there is growing, but Japan had its lost decade for a long time, and Europe doesn't want that. How did this evolve in recent months? Well, the big deterioration began back in October with the fall of headline inflation down to 0.7%. The ECB reacted immediately with the rate cut in November. It was 0.5%, then it fell to 0.25. The headline inflation further, it went a bit up, a bit down, but it deteriorated to 0.5 in March. And now again, for data released just today for May, we see that headline inflation is at 0.5 once again. It's not a final number. Core inflation, which has become more important, even though it's not the official target of the ECB, is already at 0.7, also for May. It didn't go further down, but it's low enough. So the fear is that this will snowball into deflation, into an outright fall of prices. Up to May, the ECB denied the danger of deflation. And even now, they don't want to talk about that too much. But they did warn that if inflation remains low for a long time, or it's called lowflation also, it's dangerous. It'll be a situation that will be harder to get out of. So they did say that. Now, the exchange rate, we're into Forex, and Forex has become more important also for the European Central Bank. Stronger euro means that exports out of the Eurozone become less attractive, they become more expensive. It also, and this weighs on the economy, and it also makes imports cheaper. It means that prices are pushed lower, once again. Now, each time the euro is too strong against the dollar, each time it moved towards 140, it triggered comments. And eventually last month, it almost touched 140 until Draghi hit it hard on the head. But it's not only euro dollar, it's also the Chinese yuan. China is the world's second largest economy and a big trade partner for Europe. When the yuan, Chinese yuan appreciated against the US dollar for quite some time, it seemed like a one-way street. But then eventually, earlier this year, the Chinese authorities began weakening the currency. So the yuan became weaker against the dollar and eventually weaker against the euro as well. So trade conditions with China, between China and Europe, became less favorable. So it's not only the dollar. Also, it's important to mention the yen, Japanese yen, which is still weak. So what did the ECB do in the past year or so? They tried to talk down the euro in various ways. They began with very distant hints, like technical readiness to set a negative deposit rate. At the beginning, it had a big impact. Back in April, Draghi said that the governing council is unanimous about the options to use non-conventional monetary tools, hinting about QE, like printing dollars, what the US did, or what the UK did, or what Japan did. And then even talked even in a stronger manner, explicitly connecting monetary policy to the exchange rate. So saying that not only that the euro has a more important role in the ECB decisions, even though it's not a target, but saying that if the euro would go higher, it would trigger a policy. Each time he said something, it had a small effect. At the beginning, it had stronger effects, and these effects were diminishing. In a perfect world, Mario Draghi and his colleagues would prefer to have a lower value of the euro without having to act. This way, the ECB keeps all its tools and doesn't waste them. Interest rate is already at 0.25%, so what's left is only what's called non-conventional monetary policy. We'll talk about that soon. This worked very, very well with the OMT, outright monetary transactions. And back in 2012, when Draghi, we can say single-handedly, stopped the Eurozone debt crisis by saying he'll do everything it takes to preserve the euro. So just talking and no action worked for him. But this time it does. He would like to do that again, but it didn't work for him. So has a diminishing effect, verbal intervention. So Draghi went for the ultimate verbal intervention, is just a clear threat. What he said last time is, well, you can see it in this moving image, but he made a clear hint after a dramatic effect. Okay. So he said basically that the ECB will act in June. They're waiting for the staff projections. Staff projections are for long-term, medium-term inflation. But we can assume that he made it clear that it's imminent. Now we can say once again, well, here's the details again, feel comfortable to act in June. And the result was this time his threat, not his hint. He sent the euro down at the beginning around 150 pips in the immediate aftermath of the press conference. But afterwards, we've seen it fall even more than 400 pips. Now it's around 350 pips down from the top, more or less. Now we can say, okay, what was it just a bluff to hit the euro? Once again, a verbal intervention didn't work this time, and you just talked and you wouldn't act now? I don't think so. Why? Draghi and his colleagues repeated the heavy hints on almost a daily basis. Whenever they had an opportunity to get close to a microphone, they made it clear that action in June is imminent. And in addition, okay, we've seen exciting falls in the euro for its traders, but in the bigger scheme of things, the fall of 2.5%-3% is not that big, and it can reverse very quickly. So if the ECB fails to deliver in June, that means just in 2 days, it would send euro dollar shooting higher quite easily. So what will the ECB do? We'll first discuss the potential tools. Here are 6 tools, and then we'll see which have bigger chances and which aren't, and which are priced in and which aren't. So let's begin with the obvious conventional monetary policy tool, the interest rate. The interest rate now stands at 0.25%. When Draghi entered his position at the ECB, he lowered it gradually from 1.5% to 0.25. It's basically almost nothing. Lowering it to 0.10 or 0.15 will just have a small effect on the real economy. This is basically priced in. But it will not come alone. It will come with the second tool, lowering the deposit rate. The deposit rate is what the ECB pays banks when commercial banks, place money with the ECB. So the deposit rate was lowered to 0 quite some time ago, when the main lending rate stood on 0.75, and since then, in the next 2 cuts, the ECB did not change the deposit rate to negative, but just left it on 0. So the interest rate cut is priced in, and it will probably not come along. Negative deposit rate. It'll probably, the corridor between the main rate and the deposit rate will probably be left at 0.25. There will be a negative deposit rate of 0.10 or 0.15. The exact number does not really matter. The basic idea is that ECB punishes banks for parking money. So they're supposed to lend out the money. And the side effect, it may be wanted, maybe not, is that this will drive money out of the Eurozone, therefore lowering the exchange rate of the euro. So this is a half conventional, we can say, tool. It has been used in Denmark recently, but not from a major central bank like the ECB. However, it's considered the nuclear option or unconventional tool because it hasn't been tried before, and because it can send too much money out of the Eurozone. It can have unintended consequences, such as hurting the banks, which the ECB clearly doesn't want. And if it doesn't work, it's even worse. The tool is gone, even though you can use it again and lower the negative rate even lower. So the big question is this already priced in or not? Well, it has been talked about for over a year. ECB said many times before that it's technically ready to announce negative deposit rate, but and it seems impossible to cut the main rate without the deposit rate. So this seems to be priced in, isn't it? And just setting it will not hurt the euro. I think there's no full consensus that the move is coming. If you look at polls by Reuters or Bloomberg, you see clear consensus for cutting the main rate, but unless not such a full consensus on cutting the deposit rate to negative, it will be an historic event. It could gradually push money out of the Eurozone because the ECB would be punishing banks. So I think that it maybe priced in for the short term. It means if this move comes on its own, we won't have a big impact on the euro immediately on Thursday. But when money begins flowing out, I think it can have a gradual negative impact. on the common currency. So this is the main one of the big things. But the ECB has also more tools. First of all, this is not a tool, but actually a message. But what the ECB does usually is talk, and talk has impact as well. I believe that the ECB, that Mario Draghi in the press conference will want to secure a success of his move, will want to secure a lower value of the euro, and without having to act once again. So we have forward guidance from the ECB. The ECB pledged to keep a low interest rate or even lower for a long time. So this will be reiterated. The ECB, I believe, will not remove it. Another thing is we might have an explicit hint about even lower rates. That means that Draghi will say something like, or not say, but a hint that it's only the beginning, and leave the door to QE, quantitative easing. We'll mention that too later on. So I think that a dovish message, a message that says we'll probably do even more if necessary, is not fully priced in. Market is focusing on what the ECB will do now and not later. But after the ECB does announce the rates at 11:45 GMT, that will be already more. It'll be sort of understood by the markets, and the markets will begin looking forward. So more dovish talk is probably not what the market is thinking about right now. So I don't think it's fully priced in, and it could weigh on the euro. Another thing that has somewhat lower chances, but I think there's a good chance. I think it's not priced in. It's called funding for lending, the funding for lending scheme. It was done in the UK. It means the ECB gives cheap loans to banks, but only if they lend the money onto the real economy. That means it doesn't give the banks cheap loans only to buy bonds or to keep the money, but to lend it out. It has been done in the United Kingdom. Success was not huge, but good enough, and could be used as a nice policy option. It's an upgrade of the LTROs, long-term refinancing operations, something that the ECB did in late 2011, early 2012, during the peak of the Eurozone debt crisis, and it didn't have real success, and so the ECB lent out money, and banks bought sovereign bonds, but these bonds still fell in value. That means yields went up, and they never reached the real economy. And what is happening now is that this money is coming back to the ECB, and the real economy, the Eurozone needs more money. So basically, these LTROs were not a big success, at least. So maybe a funding for lending scheme would be a better way. It will also work nice politically, as it will show that the ECB is helping the real economy. This funding for lending scheme doesn't have to begin now. The ECB could just present the idea and the scale of the idea, but without details. And I think that if the sum is large, hundreds of billions of euros, it could weigh on the value of the euro. The reaction of the market depends on the number. If ECB just raises this idea without numbers, or saying 100 billion euros, I don't think it will have a big effect. But if it says something like 500 billion euros, that's already, or 1 trillion of potential loans, just the announcement could have a significant impact. I think there's a medium probability this will happen. Now let's go on to ideas that will probably not happen, but we have to keep them in mind. New LTROs. Well, I already mentioned this just now. Lending cheap money to banks. It had limited success. And current programs are being returned. That means banks are giving back the money they took. So there's a money squeeze. It never reached the real economy. There is one motivation to do that. It would sort of inject new liquidity into the banks, at least, and raise money supply, but not necessarily help peripheral countries. I see it as a low probability, would just be a complementary step. Yet again, the impact depends on the size. I think that it could counter the current squeeze in LTROs, but there's a better chance. So it could be used, but there's a better chance that we'll have a funding for lending scheme, which is more targeted and could really help the real economy. And last but not least, the big threat, quantitative easing. Just a few words about what other countries did. The United States just buys bonds in the markets. It's now tapering this bond buying, but the Federal Reserve enlarged its balance sheet quite a bit, and this lowered the value of the dollar and had a side effect. We had QE1, QE2, and QE3. In the UK, we had a few expansions of quantitative easing. It currently stands on 375 billion pounds. For the size of the economy, it's huge. And also Japan has the quantitative easing. It was done in baby steps at the beginning, but since April last year, it's done big time. So it makes long-term bond yields lower, and that means interest rates for longer periods are lower. The problem is the Eurozone is not one country. And there's a big question, what will the ECB buy? Will it be government bonds? Which ones? Only German ones because it's safe, or only ones that are cheaper, but then it would create moral hazard if you buy only Greek bonds? Will it be mortgage-based assets? But this could be like before the financial crisis. Maybe they could buy US bonds and making it a clear intervention in currency markets, but that would be dangerous. Maybe gold. There's been many speculations and there are more questions than answers here. But so it's very complex. There is objection from the German Bundesbank, which is much more conservative. It'll probably be left for another day. That means the ECB will keep the door open for such an option, but not really act. I don't think it's coming anytime soon. What's interesting to note is that the ECB did post a related job offer a few months ago for someone to manage a big portfolio of bonds. So we cannot rule this out. Just keep it in mind, but there's a very low probability. If this does happen, euro dollar crashes and remains low for a long time. But as aforementioned, keep calm and not today. In summary, rate cut, the main lending rate is huge, high probability. It's already priced in. That's sort of taken for granted. If we have a negative deposit rate, the high probability of that as well, it's somewhat priced in. I think it'll have a bigger long-term effect than short-term. If we will not see a cut of the deposit rate to a negative figure, I think we will see euro dollar shoot higher back to 140 because the negative deposit rate has been one of the main threats. So this is sort of, without that, it's sort of almost basic. Dovish talk from Mario Draghi promising to do more. I believe it has a high probability, but it's not really priced in. It could have an immediate effect on, and together with a negative deposit rate, on pushing the euro dollar even lower. These, I think, are the high probability options. The lower probability or medium FLS, funding for lending scheme. I think it has a medium probability. The impact depends on the size. LTRO, compensating for current LTROs, has a lower probability. The impact depends yet again on the size. And outright quantitative easing, very low probability, and it could have a huge negative impact. These are the scenarios that I see. Of course, it could be an interesting mix. There will probably be some kind of mix of the various tools that the ECB has. We've seen recently the euro dollar bounce just a bit back up. I think we'll see it bounce back down towards the event. But anyway, these moves will probably be small until Thursday, until we have the official announcement, which is at 11:45 GMT, which is, and then a press conference at 12:30 GMT. together with the release of U.S. jobless claims. Are you ready? It's a big event. It's the first week of the month. We also have the non-farm payrolls on Friday in the U.S. We have a build-up towards the non-farm payrolls. Yesterday we had an interesting circus with the ISM manufacturing PMI, which was corrected twice. And we have some important figures from the US on Wednesday, and also on Thursday towards non-farm payrolls on Friday. But as I see it, this is such a big event. This European Central Bank had a decision on Thursday that for euro-dollar, I believe that what Draghi does and what Draghi says will probably overshadow any data from the United States. Okay, I think we've covered everything. I hope I didn't talk too fast. We have enough time, more than enough time for questions and answers. What do you think will be the next direction of euro-dollar? Let's see if there are already any questions. And I can elaborate on any points if you missed anything. Okay. I see there were some questions and some answers around what is LTRO and what is FLS. Oh, great question about something I did not mention, unsterilized S&P. So some background of that on that. S&P, I forgot what the initials are, but if someone remembers, that will be great. But anyway, it's a program that a previous president of the ECB, Jean-Claude Trichet, began back in 2010, if I'm not mistaken. It was to buy bonds of peripheral countries, especially Greece. Began with Greece, then Portugal and Ireland, the program countries, and later on in 2011 also Spain and Italy, in order to allow them to raise money in the market without problems. Contrary to, this isn't outright QE. The big difference is the realization. That means for every euro the ECB spent on buying bonds, it also drained euro out of the markets. At the peak, the program reached $200 billion. It didn't have a predefined size. The ECB just bought bonds along the way. The ECB never took a haircut on Greek debt like private bond holders did. I think the size of the program is currently under 200 billion. One of the options that was raised in the past would be not sterilizing S&P. That means not draining a euro out of the markets for every euro that stands on in bond buys. I think there is a low probability that the Draghi will touch the program because it's a legacy program. I think he will leave it unchanged. In a case that he does decide not to sterilize these bond buys, that means not draining out of the market something like 180 or 190 billion euros, if I'm not mistaken. It would have a very minimal negative impact on the euro. It is a dovish move. It is a move that puts more euros in the market, therefore devalues the euro. But since the size of the eurozone is not that big, I believe that it will not have a big impact, and I believe that the ECB will not touch this program. Perhaps it'll leave it for another day, or never do it at all. I think it's not. It would surprise me if they would even mention it. Securities market program, right? I think you're right. Thanks. Thank you very much. FLS, funding for lending. Fast lean market, yeah. Fast lean market, yeah. That's a nice idea. It's a funding for lending scheme. That means a commercial bank gets cheap loans from the central bank if and only if it lends this money out to a business that wants to expand, or a new business, or as a mortgage to a private person, or that's the general idea. Any more questions? I'm also interested to hear if you're going to be trading this event, if funding for lending scheme. Thanks, Forex Lady. What do you think will happen on Thursday? Funding liquidity supply. I guess there can be a huge number of abbreviations. The ECB likes these letters: OMT, LTRO, S&P. Its biggest success was with the OMT because it was never used. Program to buy bonds. If countries apply for programs in order to prevent a denomination effect, which means breakup of the euro. We're not there anymore. Okay, in the meantime, I'll switch back to the chart, maybe. Here it is. A line that does not appear on the chart but has been mentioned by many is the 200 moving average, 200-day moving average. The pair has been flirting with it for a few days, week or so. I don't see it. I mean, many people have been talking about it. Maybe it does have some impact, but more important lines that I see on the chart at the moment, 135.85 is strengthening, especially after the test today. I mean, it seemed a few days in a row that this line has been tested, and more important line on the downside is 134.75, which was the low in February, and the 133 line, which was bottom back in November last year. It would be hard to reach, but could be a potential for next week if the ECB has lots of action. On the upside, 136.50 is immediate resistance. But more importantly, 137.85, which provided support back in April. And of course, 140. 140 could be challenged if we don't have a negative deposit rate. Or if we do have a negative deposit rate, but some hint from Draghi that it's all over for him in terms of actions in the upcoming months. So these are the important lines to watch. Unfortunately, since early May, since the big fall, we haven't seen such strong volatility, not in the euro-dollar, not in other currencies. It's a bit frustrating. Range trading isn't a favorite thing for many traders. Hopefully, Draghi will send the euro-dollar one way or the other, but hopefully fast, and we'll stop seeing these bounces. Any more questions? It was a dramatic moment when he shook the markets last time. Aussie. Yes, what about the Australian dollar? Australian dollar, well, recently has been also stuck in a range, sort of 90 to 20, went over 93, but then got stuck once again, fell down. Tonight, well, I'm sitting in Barcelona, Spain, in Europe, so for me, nighttime, Asian morning, the Reserve Bank of Australia decided not to change policy. Some analysts thought that RBA would go more bearish, especially because of the recent budget and also because of the weakness in China, but it didn't change anything. So we saw a relief rally in Aussie dollar. In general, I think the Australian dollar has room to fall, but it sort of feels a bit too comfortable in the current range. So I think the path of least resistance would be to the downside. But at least, even though there are quite a few important releases in Australia this week, I think the focus is euro, euro, euro. When negative rate, euro is going to where? Well, I don't know more specifically, but I think that there's a chance that we'll see a fall below the 135.85 line, which is currently support, especially if it's coupled with more dovish talk from Draghi, and even more if we see the funding for lending scheme or other things. I don't think it'll reach 133. 134.75 is important support. But it depends a lot on what he says and what he does. So these are the two important lines, 134.75 and 133. Another important note towards such big events, towards non-farm payrolls, we sometimes see false breaks before the event or immediately after them. And in some cases, the false breaks are just the initial moves. And then we can see the pair getting back to range and then making the really big move only afterwards. But sometimes these are just it's just a move to take out stops and that's it. So I did present here quite a dovish stance, I think, but the best tip is always act on what you see and not bet on the outcome before the event. So the release of the rates at 11:45 GMT on Thursday is the first event. But if you want to get a better picture, follow the press conference. It's available on the ECB website, and I will also cover it with the live blog, and of course on FX Street. So it's better to react after the news, not to bet on the outcome before the news is released. FLS and LTRO, in other words, both are programs in which the European Central Bank lends money, or any central bank lends out money to commercial banks. LTRO is just loans for 3 years, what the ECB did last time, for a very low interest rate. And FLS is tied to lending out to the real economy. Which channel can I hear Draghi speaks? You can go to the ECB website. If you search Google for European Central Bank, you'll immediately reach it. If you do that on Thursday, there's always a link on the homepage of the ECB website to the live press conference. So it's quite easy. And you can I always put a link to this on my coverage and my live blog of the event, so you can also follow Forex Crunch and reach the live press conference on Twitter and on the live blog. It'll also be covered by Bloomberg TV, and it's quite accessible. It's public information. And you can always see markets move in real time to every word that Draghi says, especially when he makes a dramatic pause like he did last time. The strategy, well, I would wait for the outcome of the news and then act. No, not position before the news. I think it would be wiser to wait for the news to come out before acting. And then trade according to your... If the news is bearish, then you can sell and use stop loss and take profit according to technical strategies. Fundamentals are good for getting the general direction of markets, and technicals are good for entry points, stop losses, take profit points. That's the way I see it. Of course, some traders look only at numbers, only at price action, technical analysis. Some look at only fundamental. Okay. So while I'm waiting for maybe some last questions, I want to say thank you to FX Rate for hosting the webinar. This webinar and many great other webinars you can watch on their website. You're welcome to visit a site, forexpunch.com. The contact details are on the screen. There's a Twitter account, Android, iOS apps. I forgot to update. There's also an iPad app. Thank you very much. Either we have a second for the last question. Maybe I'll ask you a question. Is anybody trading the event on another currency, on Euro CAD, on Euro Aussie, on Euro Pound, Euro Yen? I focused a lot on Euro Dollar, but basically the Euro moved along across the board. Well, are the lower bond yields in the periphery market indicating market expectations about Thursday? No, I don't think they're. It's a great question. I don't think they're indicating. I think they're indicating caution. We've seen bond yields fall. That means money flowing into bonds, especially from China, but Japan, but also from other places. And if you look at charts, search Google for Spanish bond yields or Italian bond yields, you'll see graph falling, and until early May, and then it sort of stopped falling. So it seemed that they reached a bottom, but they're still not going up. I think the message we're reading is caution. And if the ECB will make big announcements, well, then we'll see what happens. But I think a negative deposit rate and promise to do more, even more negative, could weigh on the euro and also on peripheral bond yields. But they still have a long way to go up after the big fall yields. Caution ahead of Thursday, safe haven flows. No, I wouldn't call that safe haven flows, but rather just that the markets are standing still, not buying more bonds and not selling them. Well, for me, the term safe haven flows relates to when there's geopolitical risks such as Ukraine or North Korea or whatever, and money flows usually into Japan or into the United States, flows out from riskier places. So it's more, what I'm describing is more just anticipation, waiting, standstill, which I don't like because I like to see markets in motion, either go up or down, but that's what we're seeing. You're welcome. Okay, I think it's time to wrap up. Thank you very much, everybody, for attending. Hope you enjoyed it. I think we're going to have very exciting Thursday. We're not going to know exactly. We don't know exactly what's going to happen, but I can bet it's going to be interesting. And hope to see you again next time. Thank you, FX Street, once again. And that's it. Thank you very much.